Good morning, everyone, and welcome to today's Payments Association webinar on the Consumer Duty rules and how to embed the requirements into your product development strategy. My name is Angela Haynes, and I am the Head of Content at the Payments Association. Before we get started, I'd like to go over a few items so you know how to participate in today's webinar. You'll have the opportunity to submit text questions to today's speakers by typing the questions into the Q&A tab of the control panel. You may send in your questions at any time during the session, and they will be addressed during the Q&A session at the end of today's session. You may ask questions anonymously if you do not want your name attached to them. If you have any logistical questions or any technical issues, feel free to send a message through the chat box to Emily Beard at the Payments Association, who will be on hand to answer any questions you may have. Without further ado, let's kick off the session today. I would like to introduce Alison Donnelly, the Project Regulator Lead at the Payments Association and Director at FSCom. Alison will kick off the session today by providing an overview of the Consumer Duty rules and discuss the Payment Association's Consumer Duty report, which was published on September 1st. This will be with Max Savoy, who is the partner at Sidley Austin. We will then move on to a panel discussion. Over to you, Alison.
Thanks, Anjana, and thank you everybody for joining this. Look, this is a very important subject. A lot has already been said about the new obligations and their impact on the wider financial services sector. This morning, we want to drill into the anticipated impact on the payment service providers, the changes that will have to be made. I'm delighted to be joined in this first section by Max Savoy, who will come on screen shortly. But first, I'm going to give a brief overview of the new rules. And then once Max and I have spoken to you about the new rules and the report that the project regulator has published, I will be very pleased to be joined by other panelists. So Max, again, who's also a member of the project regulator. We will then be joined by Melissa Corkill, who is the Head of Risk and Compliance for the eMoney Institution Modular in the UK, and also an esteemed member of Project Regulator. Joining us from NatWest is their Regulatory and Trade Association lead and very good friend of the Payments Association, Jane Barber. And then we have the former interim chief executive of the FCA and my former boss, now partner at EY, Christopher Woolard, CBE. So first to the overview of the new consumer duty. And again, I know that there's been a lot said about the obligations and the consumer duty, and I'm very confident that there are many firms who are already well ahead in terms of figuring out what it means to their business and the implications. But I'm also aware that there's a lot of people who are involved in financial services firms, involved in payment and eMoney institutions who haven't had the opportunity to really drill in. And so we want to give a bit of a grounding now so that it preps us for the presentation of the panelists and the discussion ahead. And again, please do put in your questions to us. We're really keen to answer those questions, and indeed the ones that you've already put through to us. So first of all, Emily, can I ask you to move on to the other slide? So the new rules were published at the end of July, and you're probably all very familiar with this shortened summary of the new duty, which is sometimes depicted in a triangle. First and foremost, a new principle has been created. That's number 12, the first new principle for businesses in the past 20 years. A firm must act to deliver good outcomes for customers. I'm sure it's not coincidental that this wording is so much more active and commanding than the wording in any of the other principles. Act and deliver. That's my thought on it anyway. It takes precedence over principles 6 and 7, which you'll no doubt know anyway, is the treating customer fairly principle and the clear, fair and not misleading communication principle. Though where principle 12 doesn't apply, principle 6 and 7 will still apply. It's a higher and more exacting standard of conduct than principles 6 and 7. We then have cross-cutting rules and consumer outcomes, which clarify and amplify the principle. So the cross-cutting obligations define what firms must do in order to deliver good outcomes. And there are actually 8 paragraphs of rules And these rules are all set out in a new chapter of PRIN, or a new section of PRIN, which is PRIN 2A. And in there, we've got 8 paragraphs of rules alongside more paragraphs of guidance that fall into 3 categories. And they set an expectation that firms will, first of all, act in good faith, which is about acting with honesty, fairness, and openness. The standard that we're aiming for here is to have behaviour that is in line with how customers would reasonably expect to be treated. We then have avoiding causing foreseeable harm, with foreseeable being in the bounds of what's the realms of reasonableness, what's reasonable to have been able to foresee. And then thirdly, facilitate customers to pursue their own financial objectives by empowering them to make their own good decisions, by giving them good and useful information, making sure that the customer journey to stay or even to switch is easily navigable and not designed to frustrate or trick. The FCA expects firms to consider these obligations through the whole life cycle of the product or service, including the development stage, the marketing stage, the delivery, and even indeed the winding up stages when you're taking a product off market. In turn, these outcome rules help to define what is required to comply with the principle. Though no, this is not an exhaustive list. So in this section of PRIN 2A, we have about 60 outcome rule paragraphs that fall under these 4 categories. And they include rules such as rules requiring manufacturers and distributors of products or services to have product approval processes in place, to regularly review products and services to understand if anything has changed, if they're still fit for purpose, if there's any harm being created. Rules that require manufacturers to ensure that products provide fair value to customers, and that assessment actually just takes place regularly. It's not a one-time thing. It has to be seen to be over the lifetime of the product and its availability. Distributors, and we've got a new perhaps a new concept of manufacturers and distributors here for the wider financial service sector. Distributors also have to be able to understand if the product offers fair value. So there's an obligation on the manufacturer to provide that information to enable it to make its assessment. Firms must be able to evidence that they are confident customers have sufficient information and clear information to make these decisions. We have to be able to ensure that customers are experiencing and using the product or service in the way that's intended, and that if there's use that wasn't intended, is that good, is that bad, how does that impact the customer? And customers must be able to communicate with customer support services. To the next slide, Emily. So as I say, the bulk of the new rules, the new rules and guidance is in the PRIN 2A, and that section also has 20 other paragraphs of rules that fall into the category of standards. And that's about how to judge reasonableness, which is in reference to the risk of harm to the consumer, the cost of the service, and its utility to the customer. There's rules about embedding the duty into the firm's governance strategy and policies, rules about the need to monitor for success or indeed failure, and where there is failure, being able to take appropriate actions such as notifying the FCA of failures in your own firm or even a partner in the chain, and of course undertaking root cause analysis to understand what's gone wrong and how things could be done differently. So the bulk of the new rules are in the PRIN 2A, and of course there are other parts of the handbook such as the glossary and conduct standards that have been adapted as well, but that's the bulk of the rules. As I mentioned, I lead the Payments Association Project Regulator, and the new Consumer Duty has been a regular...
I didn't understand that.
The new Consumer Duty has been a regular discussion for our members about the real implication of the new Consumer Duty on payment service providers, and we really wanted to contribute useful guidance to the sector at an early stage to lead the discussion. So we've been working together as a team to produce something that we would find as an important input and to the discussion and to have real practical guidance to help payment and e-money institutions, really born out of concern that the FCA's guidance, certainly in the consultation version, wasn't very detailed in respect to how the rules would apply to the payments and e-money sector. So project regulators pulled together. Max Savoy is one of the main contributors, ably supported by Teresa Connors, who brought a lot of input and drafting skills to the report. And as Anjana said, the report was published earlier this month. Can I turn to Max, please? Would you outline the report?
Thanks, Alison. And I hope that little side announcement wasn't ominous. I do feel that is that's a response that a lot of people are having to the Consumer Duty. I want to start here by giving credit where credit's due, thanking you and also Melissa and other members of the project of the Payment Association's project regulator team who contributed to the report. As you were saying, Teresa Connors at Payment Matters and Tom Bruin at Payment Association did a real lion's share of the work on this, so particular shout out to them. And hopefully by giving everyone that credit, I'm not going to sound too immodest when I say this is a really, really useful document, and I'd encourage everyone to have a look at it. It gives an overview of the what, the who, the how, and the when of the duty, including explaining the scope in terms of which firms and importantly, which customers it applies to, how the FCA is going to measure and assess a firm's compliance, including some practical guidance in this report on the various outcomes under the duty Alison was talking about earlier. And if we could have the next slide, please. So this is kind of my favorite part of the report. There's an infographic in here, so here's a little sneak preview that maps the various elements of the duty to what we would think of as a typical product life cycle, right from, as you can see in the top left, the sort of drawing board phase through to testing, to launch, refinement, and eventually retirement of a product. And we think this is really important because this is a really key part of the duty and how it's been designed, and we think a key focus of the FCA. And also, very importantly, the report talks about the expectations of the firm's board and senior management, which is something I'm sure we'll get onto in the panel discussion. As Alison was saying, this report comes off the back of a number of discussions that the Payment Association has had with the FCA about the Consumer Duty in the course of the FCA's development over the last year or so of its final rules and guidance that we have now. And particularly some discussions we've had with the FCA and with a broad range of firms and advisors across the market about how the payment sector in particular is expected to implement these new rules. So I think the report's going to be a really helpful reference for firms, and I'm really looking forward to discussing some of the key themes with you, Alison, and with our distinguished co-panelists.
Thank you, Max. That's brilliant. I'm pleased to say we already have some questions coming in. So let's turn to the panelists. Can I invite you to turn your cameras on, join us on the discussion. The Consumer Duty has been touted as leading to a major shift in financial services. Consumer outcomes will fundamentally improve, a significant change for firms. These are some of the things that have been said about the new Consumer Duty. There's no doubt that the new Consumer Duty is a flagship for the FCA, and it's been at least 4 years in the making. Chris, you were heavily involved in the ideation and creation of the policy at the FCA. What spurred the FCA to this action, and will it truly be revolutionary?
Yeah, thanks, Alison. So, I mean, I think the one thing that's worth saying is, I mean, the FCA has described this as a paradigm shift. I think it's absolutely intended to be one of the sort of biggest changes that's been made in about the last 10 years in terms of regulation domestically in the UK around financial services. So this is big. This is meant to be big. It's deliberately big. And I think if you are in a situation as a firm, actually can feel quite overwhelming, because this is every product, every service line, every customer interaction that you might have directly or indirectly. And so, you know, a lot of the challenge, I think, for firms and certainly what we're seeing from the perspective of being now EY is, how do you make this proportionate? How do you make this actually tailored to your own circumstances when the rules are written for 60,000 firms across the market? But the fundamental driver here, and why did the FCA start down this road in the first place, was a feeling, I think, fairly widely held across the organisation and by the board, that said TCF had moved the market to some degree. If you look back at its introduction and what happened since, actually there's quite there's a number of success stories, but at the same time, TCF had not gone far enough. And I think the FCA could observe, and you can see this in some of the early consultation documents, the issues that were coming across their desk and the board's desk at the time were really systemically, you could see within them a failure to place consumers at the heart of the business model, a failure to think about consumers at every step of the value chain was where you saw the breakdowns happening. And this is an attempt, I think, by the FCA to now try and put, that whole thing about put yourself in the shoes of the consumer, put the consumer center stage in terms of every step of product design through to sales, through to aftercare and what happens after a sale's been made. That's really what they're trying to do here. This is a very significant sort of reset in terms of how they're approaching regulation.
Thank you, Chris. Chris, I see that with the wider, it's easy to see that in the wider context of financial services, because there's very different pockets of how things have been dealt with, and of course very different sets of harm. I think one of the questions that the payment sector has had, when you're talking drilling down specifically with payments, it's generally not exclusively, but generally very transactional. It's short movements of money, sometimes last longer, but it's transactional. It's not like it's a deeply complex product that 20 years down the line you might find it was really worth nothing to you. So so there's an element of feeling, I think, amongst the payment sector of being lumped into this, and a lot of extra work and burden to be placed on firms. How would you respond to that?
Yeah, so I think there is a challenge for the regulator in this of how do you write a set of rules and a set of principles and objectives and outcomes that apply to the whole range of firms that the FCA regulates. So everything from people sitting in wholesale markets through to retail, which is the most sort of obvious sort of space, and then things like payments and other services. However, I think if you start with the logic that says what the FCA is trying to do here is to think about every step of the value chain and how that each part focuses on consumers at being at the heart of this and the ultimate end customers or recipients of the service. I think it's pretty obvious to then work out, well, okay, from a payments perspective, what are the kinds of things you'd expect of a payments network? That it's reliable, that you think about the contribution payment made towards combating financial crime and the wider protection of consumers. How do you think about the knock-on consequences if a service isn't available? So, for example, on people who might be moving house that day or completing a large transaction, those kind of things. So I think there are angles that do come out, I think, specifically for payments when thinking about this. But on the other hand, you're absolutely right. I think a lot of the wider concerns in the market about distribution networks around, say, asset management or investment products and how are they meant to last a number of years, or what happens to people who are in debt around short-term credit, all of those things clearly don't apply when you're thinking about where does the payments industry fit into the wider consumer duty. But there is a very key piece of underpinning of the whole system that all of those short-term transactions do.
This is very much open to the rest of the panel. Feel free to jump in, but in the meantime, what I did want to say, perhaps for the payment sector more than other sectors, then do you get the sense that it's going to be incremental change? You know, at this stage, it's relatively early days. We've got until July to really have it implemented. Sometimes firms look at that as a very far way out in a very fast-paced moving business, and so therefore, you know, we've got some time. We don't need to do too much just now. Do you see things even after the July deadline as being incrementally improving, or do you think that there will be dramatic changes being made in firms across the business?
So, I mean, it'd be really good to get the views of others on this as well. But I mean, I think from my perspective, I mean, I think there's a few things we can observe in terms of, you know, EY and the clients we're working with, and how we think that that might sort of play out across the sector more widely. So the first thing is, obviously, there is not a lot of time until the end of October when boards have to have signed up to their implementation plans. And so, you know, that thinking about how do these rules really apply in the exact context of my business, I mean, that is very live as an issue for, you know, the full range of the market, and certainly sort of, you know, hundreds of firms that we're engaged with in some way. So, you know, that is happening right now. In terms of when we get to 31st of July next year, I mean, the FCA is very clear that, you know, at that point it is sort of enforcement on, as it were. So there will be a degree of obviously transitioning the wider industry, the wider financial services industry through this, but equally, you know, there's an expectation firms really will have completed the work that they need to complete. That said, I mean, I think what we are seeing, particularly in larger clients with much more complex needs, much more complex demands, and where technology and technology programs are going to play a very large part of consumer duty, particularly around, you know, how do you gather data and intelligence about a customer, and how do you then use that to make sure you try and aim for a good outcome. Those programs aren't going to happen instantly. You know, they are 2-3 year journeys for many of the people that are involved. And therefore, there is a degree of some temporary solutions, I think, that you'll see happen across the FS industry this side of the 31st of July, and to sort of cover then that sort of implementation gap. I think for payments, very specifically, I mean, the first things we're saying is this is not the only change. You know, there is a lot of change possibly coming down the pipeline towards the industry over the next 2, 3, 4 years. I think to some extent getting really well set up on consumer duty and is a really good way of then preparing for that wider change in terms of how you're thinking about sort of wider governance and those kind of questions. I think in reality, for a lot of payments firms, this will feel perhaps a wee bit more incremental than, say, if you were you know, a wealth and asset management firm, or if you were a large retail bank. But I think on the other hand, there will also be a lot of pressure coming up and down the value chain, particularly down the value chain towards payments, where, you know, those banks, for example, will be thinking very, very hard about, you know, what are their dependencies and how do they think about their overall offer to consumers. And that includes, you know, the security of that offer, the operational resilience of that offer, and ensuring that ultimately, you know, they can also take steps to reasonably combat fraud and those kinds of questions. And I think all of those things will be set the stage in terms of either conversations the regulator has, or conversations that key business partners have with those that are in the payments industry.
I think I'd like to add to what Chris says, is that even within the payment sector, there's a huge variety of firms. Yeah. And we've all got a different starting position. You know, we've not only do we have slightly different products and services, but a different customer base. And we will all be at a different level of maturity in our own internal data and management information, and the degree to which we're truly customer centric, and even the maturity of our processes. So I think it's really important that firms digest what is said in the consumer duty rules and guidance, but think really carefully about what that means for them. It's not a cookie cutter approach. You've got to understand your business and understand whether it is going to be, in some cases, maybe incremental improvements to what you're already doing, and maybe putting more effort into the ability to evidence that the outcomes you're providing for customers is what's required. And in others, it might be a bit more of a fundamental shift. So I think the consumer duty guidance it requires thought, and it's the same with all those outcome-based, principles-based regulatory interventions. You do have to think about what it means for your business and be proportionate in where you spend your effort.
That's very well put, Melissa. If you think about it, many of the products that are covered by the consumer duty are ones that are customers making a decision to buy a property, seeking a mortgage, considering it. Payments is so much more embedded in the everyday, and we have quite a lot of regulation on us anyway about how we need to make sure our systems are safe, how we need to act in terms of incidents and so on. So it's probably more nuanced. It may be slightly different if you are a pure payments firm where that's solely what you're offering, and therefore you need to think about it as that core product. Are you offering the right types of products? Are they giving fair value? You look across your pricing and so on. But it's a slightly different type of product, even for customers using it, isn't it? It's just an assumed one rather than one that they perhaps deliberately choose.
Thank you. Very good points. I feel we might come back to some of those points and elaborate on them, but I'm very mindful that there's a few questions that have come in, and I think it's really useful to then turn to one of the key bits here, which is really about definitions. It's the nuances with the definition. So Max, to which firms does this duty apply, and which activities of those firms?
Thanks, Alison, and apologies because there's as you can hear, there's a fire alarm test or something going off in the background, hopefully not a real one. So you're just going to have to excuse me, but I'll do my best to go over it. And if it's too distracting, come back to me. So I think this is a really important question. And in some ways, I think this is really one of the trickiest parts of the new regime. I'll give some examples of where the duty and the rules under it could apply in context where firms might not initially think they would, and I'll try and answer the question that came in the Q&A. Before we get into the weeds, though, I want to go back to basics a little bit here and start with the question of which firms are generally subject to the rule and what types of customers are in scope for the payment sector. So the duty and the rules under it apply pretty much to all FCA regulated firms, which for the payment sector includes banks, electronic money institutions, payment institutions, and registered account information service providers. So if you work with or for one of those, you're probably going to, at the very least, need to be thinking about whether and how the rules could apply to that firm, even if you only provide B2B services, which we'll come back to in a second. The regime also applies to other FCA regulated firms like consumer credit firms, investment firms, insurance firms, as we were saying, although the types of customers that it applies to in those contexts are different. So if you're a firm that's providing different kinds of regulated services, you always need to think about that point and have a look through the definitions. The duty also applies to EU firms operating under the UK temporary permissions regime. And the FCA has said that it'll be expecting those firms to be preparing now to comply with the duty and the rules under it. I'm going to keep saying and the rules under it because there's a lot of rules under the key principle as part of their applications for full UK authorization. More broadly, for any firm seeking to become FCA authorized, this is now something that the FCA is going to be looking at. It will be assessing this as part of applications for authorization, along with all of the other threshold conditions for that. So in short, it's going to be relevant to pretty much any firm that's within or knocking on the door of FCA regulation. Focusing on the payment sector specifically, and particularly the question of which customers, which payment service users are we talking about? Does it apply to customers of our customers? If we're doing B2B only, does it apply to us? So let's go through that a little bit. For firms that issue e-money or provide regulated payment services, so banks, EMIs, EIs, registered account information service providers, the in-scope customers or end users are firstly consumers, as you'd expect, an individual acting for a purpose outside of their trade, business, or profession. It's the definition of that. Also to micro-enterprises, this is a really important point that I think often gets forgotten, which includes legal entities like companies, as well as partnerships, sole traders, self-employed people, and family businesses, where any of those categories employ fewer than 10 people and have a turnover or an annual balance sheet of €2 million or less. It also applies to UK registered charities, thank goodness, and certain small charities. So, sorry, it also applies to UK registered charities with an annual income of less than £1 million. So it's consumers, micro-enterprises, certain small charities. And another important point, it applies to those categories where they are prospective customers, which in practice means that the rules apply to product development, to marketing, to customer onboarding, and even before the firm has a customer relationship. So the first question for an FCA regulated firm is, do we have, or are we planning to have, or are we marketing our services to any of those categories of customers, including micro-enterprises and small charities? If so, the duty and the rules will apply to you in relation to the regulated services you provide or you're planning to provide. It also applies to you in relation to connected activities. So even if that's not a regulated activity itself, if it's connected to a regulated payment service or issuance of e-money. What that means in practice is that if you offer add-on or connected services that are linked to a payment service or e-money, those could be covered. So for example, data or reporting services may be linked to accessing or supporting payments functionality, other functions that firms may provide on a website or a mobile app in relation to their payment services. That's the first part. So this is all just direct customer relationships. And I realize I haven't really answered the question in the Q&A yet, so let me come on to that. The duty and the rules also apply to a number of indirect customer relationships where your firm is not contracting with the consumer, the micro-enterprise, or the small charity. In other words, it can apply really even if you don't have that relationship and you don't own that relationship. So if you're only dealing with large businesses or other payment service providers or other regulated firms, you can be pulled within scope of the regime. Not always, but you can. The main reason for that comes down to some of the definitions under the rules. And I'm a lawyer, so I would say that, wouldn't I? But bear with me for a second. So the rules apply to a firm's quote unquote retail market business and its quote unquote products, both of which are defined. I'm not going to run through the full definitions, but the way those terms are defined means that this includes e-money and regulated payment services and connected services that are provided by a firm as part of a longer distribution chain. And the term distributed is also defined really broadly here and includes arranging and advising on a service or product. And perhaps even more broadly, and I think this is one of the really important points, those definitions bring within scope e-money and payment services that are provided to another FCA regulated firm, where that other firm relies on those services to itself provide services to one of those categories of customers I mentioned earlier. So let me give you some examples. If you're creating an e-money product that's going to be distributed by someone else, or if you're providing payment services through an agent, that will bring you within scope. That could bring you within scope. If you're an FCA regulated acquirer or payment processor, and you're providing regulated payment services to a payment facilitator or a master merchant, and that facilitator or master merchant is itself FCA regulated, and some of its underlying merchants are micro-enterprises, that could bring you within scope. If you're a firm that partners with other payment service providers to intermediate in a payment chain between an end user and an end payer and an end payee, that could bring you within scope. And if you're a safeguarding bank that provides safeguarding accounts for a PI, a payment institution, or an electronic money institution, the FCA has said explicitly in its guidance that would bring that bank within scope potentially. Now, if all of that sounds a bit scary, there is a silver lining here, which I'm sure we're going to, which you mentioned in the beginning, Alison, and I'm sure we'll go on to talk about this a bit more, which is that the scope of how the duty applies and the expectation. So even if the answer to that question posed in the Q&A is yes, it can apply to you, the scope of what's expected depends on your role. And particularly, it depends on the impact or the material, whether you could have a material influence on outcomes for that end user. And there is very, very sensibly, I think, a reasonableness standard that's built into the rules. And this is something we've discussed at some length with the FCA, and hopefully we can discuss that a bit more among the panel too. But if there's two things I want people to take away from all my yapping on about definitions and scope, it's firstly that the rules can apply to certain unregulated services provided by regulated firms, and secondly, they can apply even if you only provide B2B services. I'll pause there.
Max, thank you. Sterling work getting through with the background humbug. You did very well, very professional, and it was like a beautiful decision tree. I mean, you could just see the infographic behind it. So thank you for that. That was very clear. Would any of the other panelists like to jump in just now? Christopher, Jane, I see your microphone's off. Or your mute's off.
No, I'm fine not to, because I thought it was a really helpful explanation too, and very useful. Certainly reflects on some of the things that we've been thinking about for payments as well.
Thank you.
I mean, I thought it was a fantastic soundtrack in the back of it, in terms of it's almost appropriate.
It's all very ominous, isn't it?
We're at DEFCON 3. I mean, I think the one thing I would say is, I mean, just looking at the questions, I think the way to frame this as a simple sort of rule of thumb is, if ultimately what I'm doing here touches and can impact upon customers in the way that we would think of them normally, so you, me, anyone else going about our daily lives, and also the smaller end of firms, but that's still probably about 70 or 80% of actual companies in the UK. If it can impact them in some way, then probably this is in scope, directly or indirectly. The only other thing I would just add is, and the FCA talks about this a little bit, there is clearly an interaction between the SMCR and these rules. So your fitness and propriety as a senior person is judged by the FCA not just about the activity you conduct within your regulated business, but also what you're doing within your unregulated business as well. So as Max was saying, there's a breadth of scope here in terms of the activities you might be doing. So getting into a sort of narrow argument about this is a regulated activity or it's not, or I haven't got, I've got a B2B relationship, I haven't got a B2C relationship. I think that's sort of reading this wrong. This is about what is going on in the whole value chain.
And Chris, sorry, you go ahead, Melissa.
I would also add, if we take too rigid a view to defining who our in-scope customers are, then we maybe miss where micro enterprises grow or cease to grow. And there is something, I think, also to think about the interventions we may be making, the changes we may be wanting to introduce to our firms in order to be compliant with the rules. Operationally, in some circumstances, it may make sense to take a broader definition than strictly the FCA say, not only to make our own operational processes simpler, but because we might find that there are benefits to our business in applying some of those principles and ways of working to that broader customer base. So I think it would be, obviously, you've got to understand your customers, you've got to understand where the biggest risks are. You've got to understand your role that you play in the distribution chain and how that will manifest itself in terms of responsibility and particularly with co-manufacturer agreements. But I do think we could get too hung up on defining very precisely the target and actually miss a trick in some of the wider changes, which will ultimately improve our ability to meet the other principles 6 and 7. So I think there's a little bit of a practical trade-off sometimes, but I wouldn't dispute the starting point is understanding the customers and your role in that chain in providing that outcome for them.
That's a lovely point, Melissa, and you know, we can often be accused of, well, some people, perhaps professionals in consulting firms, might be accused of making things overly complicated and overly complex. I'm sure there'll be plenty of firms trying to get the nuances right on the definitions in order to find a way of for that falling in a convenient place. But nonetheless, I think it's important to consider, even as you said, the changes in the market and firms growing or not growing in size and what have you, but also I think future plans, because as Max mentioned, we've got you know, applications coming in who are already, and certainly in the payments sector, facing significantly more scrutiny than they were last year, the year before, and the year before that, significantly more scrutiny. And it's a very easy question for the FCA to ask, you know, what are you currently doing if you're regulated? What are you currently doing as a payment and e-money institution in respect of your customers, and asking for more detail along those lines. If you have been involved in the chain in some way, even if you're not the regulated entity, so it's not a case that your payment institution changing to e-money, but you've been an agent or distributor, I would expect that there will be questions being asked about their involvement in those processes, even though they're not regulated, but it's to understand how that has impacted on what they've done to date, with a view to how it would look in the future.
I just come in very briefly on one point. Chris made a really good point about the SMCR and governance, and I just wanted to make clear to firms on this webinar that point would apply. Well, Chris, tell me if you disagree with this, but I think that point would apply equally to firms that are regulated that are not within the senior manager's certification regime. So payment institutions and e-money institutions have very similar obligations, as a lot of people on this webinar will know, about getting directors and senior managers and head of control functions approved. And I would think the FCA will be looking at this in the same light in terms of their governance arrangements, embedding this within the culture of the firm, and also having board oversight and really board buy-in to this process. This is something that's come up quite a lot when we've talked about this. This is not just something for the head of compliance to add to their list and create a checklist for. This is something really the board of a regulated firm is expected to be involved in.
Yeah, no, I mean, I think that's entirely fair. And I also think, I mean, Melissa's point, I think, is a really important one. I mean, particularly around small firms, I think virtually all, in fact, all, not even virtually all, all of the major banks in the UK choose to take a much broader definition of small firm than necessarily the source books require, in order to actually think about the simplicity of their own banking operations, actually who the target market are, all of those sorts of things. So even on a voluntary basis, even though this is very, very wide, actually when you get to the implementation of it with certainly major players in the market, they're even going wider. So yeah.
Perhaps we could take a little thought through, I'm just mindful of how long that might take in terms of the processes. If you're involving the identifying, first of all, you've got to identify the extent that it impacts your business and the various ways it impacts, but then other partners in the chain. And there's been relatively recent examples where it has had impacts on the chain, the Premier FX case and the Wirecard case. Would anybody like to discuss how that the involvement of those other parties and finding how they sit together, how that'll work for firms?
I can make a start on that if you like. I'd love to hear from others too. Unfortunately, there is no one size fits all answer to that. And, you know, Melissa made that point earlier about all of this depends on what a firm's doing and its role. But I mean, if you think about it, where could a firm in a payments chain kind of mess things up for an end customer? Where could it get something wrong or not think about something properly or price things in a way that could end up really hurting the end user? I think it's those kind of things. You know, Chris was talking earlier about fraud and data security and things like that, which we'll probably see more rules on in the years ahead. But I think that's really important too. If you're a firm in a chain and there's a settlement failure, or you're not taking the instructions properly, or you've designed your processes in a way that could adversely affect the end users, and you haven't really thought that through, then you probably haven't done your job right. And I think that's part of what the duty is getting at.
Thank you. And just before we move off the definitions, there's a question that has come in about what exactly are open and closed books meaning within the regulation. Anybody want to give us the definition?
I was going to leave Max to do definitions on that if he wants.
I was just frantically checking to see if it was a defined term, and I can't remember. And if it isn't, I'm fairly sure, but someone else will please correct me if I'm wrong, that this concept, it is defined. A closed product is a product where there are existing contracts with retail customers entered into before 31st of July 2023, and which is not marketed or distributed to retail customers on or after 31st of July. So really it's a product that, as at that date, 31st of July 2023, is no longer being sold. It's no longer being marketed. It's out there, it's being run, it's servicing these customers, but you're not accepting new customers. It's that concept.
And still worth saying, the duty still applies to that group. It's just that there's longer then to comply with making sure that they're in the right position.
Exactly, yeah, good point.
Thank you. Jane, there's been a lot of discussion during the various consultations about whether the new consumer duty shifts the balance of responsibility in some ways from customers and onto firms, and certainly considering the sort of various obligations and indeed the amount of work to be put into getting this right. The FCA has been very clear that this is not their intention, but how do you see that playing out going forward?
I think ultimately, particularly if we're talking about consumers, micro enterprises, and indeed other customers, we have a duty already, I think, even if it wasn't called a duty, to make sure that we're selling appropriate products to our customers and treating them fairly. So it's not going to place more of the onus on customers. The onus is probably more still on the banks, because as Max and Chris have said, it's a change. The FCA expects, well, partly because I think it's seen some things that haven't worked well. It's given examples of that in the sort of non-handbook guidance, and that therefore the expectations of what we need to do, both to understand our customers, understand the products that we're selling to which customers, so that they're more defined, i.e. we know which customers they're most suited to, for example, particularly if they're complex products. Thinking more about vulnerable customers and their needs, particularly if they're looking for a product and may not understand it as easily. So that could be our communications that need to change. And at the end of the day, although there's this reasonableness focus on it, it's all about delivering those good outcomes, isn't it? And we're going to have to measure those. And I do wonder whether, if we look back over the period of the pandemic, that people have got more remote from things, and therefore we've all had to work differently. It's almost about now bringing it back to, so we get back into a more normal way of life. How do we refresh everything and think about what should things be like as we go forward? Because there are great opportunities here. Because there are some things that are changing. We've talked about payment systems changing, new opportunities there, but we'll need to think about all the stages in those journeys as we do for other products. And looking, as I was thinking about this, as the FCA gave an example of a poor communication, and I'm sure I received one of these and thought, why have I got this? It was where they'd sent out a sort of a single and very long communication covering a whole set of things that customers needed to think about. But you as the customer had to need to work out if one of those was relevant to you or one or more was relevant to you. And you think, an odd thing to have done. It sort of seems slightly perverse, doesn't it, that you do that and send that to a customer? Was it cost saving? Was it just easier to do? Was it a nice roundup? I don't know. But you have to think about that. And although I think we'd all say that we've thought about how we communicate, whether online or in written communication or face to face, how much have we tested it in the past? Who do we test it with? That's going to be critical as we go forward, getting sort of more end user input to our communications. And also, if when we speak to somebody, say on the phone or in a branch, do we become that enthusiastic salesperson just because we can't help it, because that's our role, or the overly technical employee that bamboozles the customer with things about the product, which of course, how does that help them make their decision? They need to know much more clearly what's the product about. Why would they buy that product? What would it allow them to get? What would it allow them to do? Is that right for what their circumstances are? So overall, I think it's about firms thinking very carefully about this. It's about the customer journeys, what it means to customers, and what do you do now and what will need to change. And as has been said about thinking about how you go about implementing the duty, is you'll have some products that are sold en masse to customers. They might be the ones that you need to focus on most because it affects more customers, and that's why you need to start thinking about them. So I'll stop there because I know we've got lots more to say, but that's my thoughts on that.
Jane, thank you. And having worked with some payment and e-money institutions, and indeed as part of Project Regulator in trying to help them communicate to customers the pros and cons, shall we say, of safeguarding, at the very least, it's definitely not easy. And I'm confident that every firm wants to communicate well, and certainly feels that they're providing the right sort of level and depth of information. How it's received is probably a different matter, and it's going to be received differently by different people. Anybody else?
I think just building on that, so even if we think as a firm we're doing the right things and we're communicating in the right way, we may not be able to right now evidence that in a way that would properly satisfy the FCA. So I do see that we can't be too complacent. I think it's quite easy as a firm to think, yes, we're fine, we're customer centric, we've already got a solid customer journey. But if we're not able to evidence that's leading to the right outcomes, then I think we will fall short of the expectations here. So I would just sort of reinforce what Jane is saying and add that on as well.
Yes, I'd agree with that. I mean, it's going to be quite difficult, isn't it, to evidence every single conversation, but it's about almost building that, what is the sort of things we should and could evidence, and that as we cascade it out to our colleagues and what needs to be done, that they're really clear about that when they make their notes and so on, that we can show that we've followed through as we're discussing the product with customers.
And doing that in a proportionate way as well. So I think the point you made about whether the product is mass market, or if there's a subsector, which takes you back to almost the beginning stage of really understanding what the products and services you're offering are and who is your target market, and how do you know what you know enough about your target market to know how those people should be communicated to and in what way.
Yeah, no, I mean, I completely agree with that. I mean, I think there's sort of two things that are possibly a bit countercultural in many organisations that are worth thinking about here. So one real life example, and then one way in which certainly as a regulator, we often thought about these problems. So the real life example, and it's one of the cases that actually caused the FCA to really think very hard about the need for a consumer duty, is you had a particular case, vulnerable consumer, this is obviously pre-COVID, walked into a bank branch, set up a payment to an overseas company. That company happened to be based in a FATF, so that, you know, the money laundering bodies, a FATF high risk jurisdiction, and then the consumer proceeded to empty their account, sort of £5,000 at a time, all their life savings going on a scam, a very sophisticated scam, but nevertheless, you know, there it is. And I think what was interesting in the firm's sort of defence of itself around these things, and it did defend the case, but I think there was a lot of thought went into, okay, if we've got this wrong, do we need to do lots more controls around vulnerable consumers? Do we need to do, you know, more training of our people? Could we have spotted the vulnerability, etc., etc., etc.? And the conversation was around that, rather than saying, well, actually, if you introduced some friction for all your customers on the first time they ever make a payment to a FATF high-risk jurisdiction, you know, would you actually get a much bigger benefit for, you know, customer outcomes, society, fraud prevention, all of those sorts of things, rather than constantly trying to, you know, educate your people about all the different nuances around vulnerability that, you know, ultimately will come down to a human judgment on the front line. You could actually hardwire a change into your systems and controls that would actually not just benefit vulnerable consumers, would benefit all consumers. And so how you think about those kind of problems and how you frame them, I think, is important. The other piece in this is, you know, what lessons can be learned from other sectors. So I think often we think in the financial services sector of sort of disclosure almost being a bit of a panacea. So I've told the customer about it, therefore, you know, it's okay, I've discharged my responsibilities. But if you think about it, I mean, none of us would accept walking into a car showroom, the salesman saying, this is how the internal combustion engine works, this is how the 7 onboard computers work, and then if you drive 100 yards up the road with your new car and it blows up, you go, oh, well, I was told how the computers work, so, you know, that's all on me. And I think that sort of blend and nuance, and this is more obviously in the retail space, I think, than in the payment space directly, but you know, lots of firms, I think, will be thinking about this is, you know, does this change the way I actually approach my customers in quite a fundamental way? Does it change the nature of the products and services I'm offering? You know, how far do I have elements of sort of guarantees that products will perform in certain ways up to a certain point, and so on and so forth, that really sort of mirror sales practices in lots and lots of other markets. And I think that will be something that we see play out over time through the whole value chain, because clearly there's going to need to be adaptation of other parts of the value chain if those products and services are going to change in some fairly fundamental kind of way.
Do you think, Chris, that might manifest itself in some forms of other consumer protections then?
Potentially, or actually firms competing on, you know, actually very different business models to the ones that we've seen so far. So, I mean, without drifting way too off topic, I mean, I think the debate around, is it advice, is it guidance, am I explaining things simply to the customer, am I nudging them, am I genuinely providing financial advice and therefore I'm on the hook? You know, that whole swirl of things, I think, has often been driven very much by well, where is the liability, and, you know, how do I define and limit my liabilities as a financial services firm? You know, what we've seen historically in food, although obviously there's very strong regulation of those spaces now, on, you know, the whole kind of growth of brands during the 20th century and the 19th century as well. You know, it was often based on firms saying quite voluntarily, without regulation around it, I'm going to serve you, the customer, in a way that is safer, more reliable, more dependable, you know, more certain for you. I'm going to offer something different to, you know, the baseline of what I'm legally required to do. And I think we may see certain firms. I know there's firms who are genuinely seriously thinking about this at the moment. Of, you know, does Consumer Duty act as a spur to them to change some of their business models, to change some of the ways they're serving markets, and helping people genuinely achieve the outcomes that they're trying to achieve? But that, you know, but will break the mold, I think, on some of the wider business models that, you know, are really very, very entrenched, I think, across all sorts of different bits of financial services. So I think some of that change could be happening a little bit more radically than even, you know, the FCA is trying to push the market towards. I think we have to see whether that's successful or not. But I do think, you know, if we drag this back to the fund payments perspective, I think the other thing to be thinking about, as well as, you know, what are the demands of the rules, actually how might this change the behaviours of some of the principal B2B contacts that you have, and their demands actually of what they're going to need in the future.
Can I just come in very quickly on one point? I agree with all of that, Chris. I think that there's very, you know, very important points. Jane, you gave a really good example there about customer communications and how that can go wrong. You know, maybe not maliciously wrong, but just through kind of lack of thinking through how will the customer receive this. When we've talked to the FCA about, you know, one of the sort of questions we've had on this whole regime being applied to payments is, what's the harm? You know, what's the harm you're trying to address in the payment sector specifically? I look at these rules, I see these definitions of manufacturer and distributor, and the first thing I thought when I saw the early draft of this was, that sounds like packaged retail investment products. All of this, all the wording, all the definitions kind of makes sense for investment products. How is this supposed to apply to payments? And one of the things the FCA said to us, and they've actually put this now in their final guidance on the rules, one of the few things they say specifically about payments is talking about communications and talking about complaints. And one of the things with communications is how firms, you know, represent what is regulated and what isn't, and safeguarding, and how that's different from, you know, deposit protection under the Financial Services Compensation Scheme. But I think it goes broader than that. I think it goes to exactly those kind of points. You know, are what you're asking or what you're telling your end customer, those things, do they make sense if you put yourself? So there's a question in the Q&A about, you know, could we sort of sum this up in a very sort of simple terms of putting a consumer at the center of what we're doing right, or do as you would be done by? And I think that's a really good way of summing it up, a really good way of thinking about comms. So I'm not saying that's the only thing the FCA is going to be looking at, but we know we know pretty much for sure that's going to be a focus.
I feel if you're looking for a new business enterprise, then getting into mystery shopping, focus and sounding great will probably do you well, because there will be a lot of firms needing to get real evidence, real understanding of how they're because we've talked about how you communicate it out. There is, of course, the point about how you communicate in, how you hear what they're saying, and of course, social media and the power of social media in changing firms. I think firms will have to be a lot more alert as well to what's coming through that way.
Yeah, even simple things like, how easy is it for an unhappy customer to access the help that they need? You know, is it straightforward? Some firms may be making it very easy for people to engage in online chat, but trying to find a telephone number to talk to someone might be incredibly difficult. And I think there's something about, certainly, what would we expect? How would we expect to receive the support that we need? And is that being provided, if not by us, but our partners in the distribution chain? And what might we do as an EMI with an agent distributor model to make sure that, you know, those responsibilities are carried through across the chain?
I can hear firms saying this is going to be super expensive. Can't you hear that? Because And obviously the cost then does get passed on to the customers. There's, you know, whether that's firms can't run the business model that they want to run, but you can hear and there is a question in about the firms who are arm's length, and of course embedded finance is a great example of how the payment service provider is so far back, somebody else is running the whole regime and they're doing the customer service, and that's going to incur a lot of costs. Do we have any thoughts on the sort of proportionality and how that will play out for firms?
I mean, so look, I mean, really we need the sort of the FCA sitting here to answer this one, I think. But I mean, if you look at the cost benefit analysis they put out with the sort of final version of this, I mean, there's not a lot of attempt to quantify relative cost to firms versus, you know, the potential benefits of this. More an assertion that says, look, you know, the benefits of this will be potentially so great in terms of, you know, fraud avoided, outcomes met, loss of mis-selling, etc., that, you know, whatever is thrown at this in terms of implementation costs will be kind of dwarfed by those benefits. Now, you may or may not agree with that view, but I mean, that's essentially how they've justified the final sort of rules that have been made. I mean, I think the other side of this is, I mean, certainly we have clients who are absolutely approaching this and saying, look, this is just a cost. This is just an additional cost of doing business. And, you know, we obviously need to try and minimize those and be as efficient as we can about them. And the proportionality piece here that we were talking about earlier is really important. So, and I would say probably just about the majority of certainly our clients at EY are thinking about it in that way. But there's another group, and quite a significant group, who are also saying, look, back to what we were talking about a few moments ago, this is going to be big. So let's just take a step back and start to ask ourselves some slightly more fundamental questions about how we run the business. So most businesses historically have had, here's compliance, here's sales, marketing, call it what you will, customer relationship management. Many firms are out there in the market at the moment at the retail level, spending a lot of money updating how they use data, how they think about that in the context of customer relationship management and increasing revenue. However, a lot of them are also saying, hang on a minute, you know, we're collecting virtually the same data sets that we need in order to show we've got compliance with the Consumer Duty, rather than let's build a huge, great compliance system and a huge, great customer relationship management system. Why on earth aren't we just building one thing and able to take data off of it that's one version of the truth for us and look at it through different lenses, whether that's about, you know, how the business runs and commercially makes its money, or how the business runs from the perspective of compliance. And I think that's a really big shift. I think there's lots of other sectors, you know, telecoms and others, who for years have done exactly the same thing. I think in financial services, we've seen, you know, actually these things build up as very separate and sometimes contradictory systems for gathering data about customers. So I think there's, you know, there's both an efficiency play that some people are looking at here, but also, I mean, I think if you go right back to the, you know, why did the FCA do this in the first place? What were they trying to drive? And that concept of put consumers at the heart of the business model, actually, I suspect from an FCA perspective, quite encouragingly, we are seeing clients who are saying to themselves, right, because we know this is for forever, as it were, because we know that this is something that's happening in the market that will be with us for, you know, that very, very long period of time. Let's do it in a way that actually adds the most value to our business. Let's do it the most efficient way. And in doing so, they are genuinely embedding it in a way that it isn't the sort of semi-detached compliance activity. It's actually part of what people are doing day to day. And in that world, there are, again, you know, a subset of that group who are saying, could this give us a really big competitive edge if we did this well, compared to our rivals in the market? And could we have other products and services that for years we've avoided that could serve and meet the objectives of people who, you you know, otherwise wouldn't get the best deal possible out of, you know, whether it's banking or insurance or, you know, whatever it might be. So I think as this plays out, I think you're right, Alison. I think most people are still going to look at this and say, this is a very significant cost and a very big program that I'm going to need to have. But there are already, I think, people who maybe started this journey 2 or 3 months early before their competitors, people who are saying, actually, if we embed this in the right way, we could actually turn this into something that net is profitable for them.
Well, that will certainly be good news. There's 300 people on this webinar. If anybody came onto it thinking, I only need to listen for a little bit because it really doesn't affect me, then I think they probably will be convinced by now that there is certainly a job of work to be done, and to see the breadth and depth of that job of work. Melissa, can I turn to you then and ask you about the challenges that you see in your own role with Modular, but also in your broader role as your discussion with other member firms in the project regulator and the Payments Association more broadly. What we know that the deadline, we've already mentioned it, we've got the 31st of July for the full implementation, and that was a slight extension on where it was originally to be, but we also now have this board paper very clearly put in. The board plan has to be put in by the end of October. I think FCA is learning from previous experience about making sure that there's earlier deadlines to help people ease their way up to the farthest reaching one. But in your role, what do you see as the challenges in meeting these deadlines?
I think the challenges are that it's very easy, first off, to get stuck in spending a lot of time doing sort of analysis, but actually not cracking on and making some changes. And while the deadline for July has been extended, it's still a relatively short window. I don't think firms should panic, but if you're not already started, get started. And really the key points are about quickly assessing the areas of greatest risk for your firm. So touching on the comments we made earlier about every firm being different and having a different starting point, you should already have a reasonable understanding of what is going to be most problematic for you. And in terms of having a plan approved by the board at the end of October, it doesn't take that long to put a relatively high level plan together. Work backwards from the dates, build in some contingency, think about the activities that will likely have the longest lead time, which, you know, could well be systems changes to improve your data and MI, or where you're needing to engage with other players in the distribution chain. Those things generally take some time, and then look to build out the detail of that plan as the information becomes available, and expect to iterate it. So I don't think I would also say don't think you only need to start working from 1st of November on actually implementing the plan. A lot of activity should already be underway and building alongside up to that deadline. And the benefit of getting going earlier is if you achieve ahead of the target deadline, well, that's brilliant news. But I think these things generally take longer than people expect. And I think what's particularly important about the consumer duty rules, and I think Chris was talking about this in the way that it needs to be embedded in the fabric of the organization, is that it's very broad. So even if as a firm you don't feel you don't identify massive changes in all areas, you're still needing to engage with people across the firm, and that takes time. So certainly if you've not already, you know, mobilize, make sure that not just the board, but the senior leaders in your firm who are going to be accountable for operating and delivering to the consumer duty for their area of function really understand what it is about, so they can start applying it to their thought processes. And I think touching on another point that Chris made, you know, in terms of embedding it, we should also be thinking about the activities we already have underway as firms, whether we have a process improvement initiative or an initiative to improve the quality of our data, and take that consumer duty lens and apply it to some of that work that might already be underway as part of normal continuous improvement. And by putting that consumer lens on those activities, I think we stand a better chance of them really landing and not being seen as simply a separate compliance project, but something that's properly integrated into the business. So I think that's probably, you know, some of the key practical things I would say. We know that the FCA say that they will be reasonable and we need to be proportionate. So taking a risk-based approach and considering carefully what that means for the activity that our firms do and the relationships we have with others in the distribution chain is probably the key.
And when we talk about deadlines, it's always worth, you've got the, you know, is that a carrot? But there's definitely a stick capacity here. Chris, perhaps you could talk to us about what action you think is likely to be seen from the FCA once we pass the July deadline.
Yeah, I mean, so I think one of the things that's sort of slightly skipped out of the debate is, you know, the idea of a new principle sounds quite academic. You know, it feels like, wow, we've got a new principle, marvelous, you know. But the reality is, and you'll know this from past life lessons, you know, where you get an FCA enforcement notice, it starts from the breach of a principle. In some cases, it stops right there. You know, if you breach P11, i.e. you've lied to the regulator, then you know, that's it. I mean, you know, there are people who've basically, you know, been sanctioned, fined, their careers have ended purely just straight on the breach of a principle, let alone an underlying rule. And so, I mean, I think one of the things that's worth remembering here is, because this is outcomes based, because although there are some detailed rules sitting underneath this, there's an awful lot of judgment, interpretation that's going to be needed by firms to their individual circumstances. And ultimately, you know, we talk about principle-based regulation, this is probably about as close as you can get to it. There will be a degree to which I think, you know, how precedents get set in this space, how clarification happens in this space is going to be, it's ultimately, it's enforcement led.
I think enforcement led, clearly that takes time. There's a big process for that. What's easy for the supervision to do is easy for at the gateway is to ask, easier at the gateway is to ask the questions, and you don't get them in at that stage. So I think we can see a big change in the applications sort of stage as well.
Yeah, no, absolutely. So I mean, I think, yeah, absolutely. I mean, across the piece, you will get this supervised. I mean, I think if you look at the FCA's forward business plan, this is the kind of key policy initiative, and then an awful lot of problems as they're coming up are, you know, often the response is, aha, yeah, the consumer duty is going to deal with that. So you will expect active supervision. The whole October deadline is about having quite an active dialogue with supervision potentially. I think you will get policy tweaks. I mean, I think you will get some updates from time to time as this goes forward and the industry and the FCA get more experience of what it means in practice. But I think the FCA will try and avoid that in the first instance. It will say, you know, work these things out for yourself. And as you say, I mean, at the gateway as well, this is now part of, if you're applying for authorization for a new entity, it's going to be there. And I think there's a really interesting question, if I can just grab it out of the ones that are scrolling through, saying back to this question of cost, back to this question of, you know, how intrusive might this be? What are the additional burdens at the gateway? All of those sorts of things. And, you know, does the regulator seem to be thinking about the viability, particularly of smaller payments firms? Or actually, you could broaden that. I think smaller firms in general in many sectors. And to be fair, I mean, I think what you can see happening, and certainly when I was at the FCA, this was sort of discussed and debated in the same way that when a whole series of additional standards were introduced in the legal industry, you did see a fall in some of the smallest entities in the market having to exit because they couldn't bear the costs of sort of advanced regulation in the solicitors market. But the level of misconduct and complaints in the legal market fell massively. So I think there is a degree of deliberateness going on here. I'm not sure if the FCA stated that very publicly, but I think there is a degree of deliberation here of saying, if you get higher standards, that may impose some higher costs, and that may well lead to some exits, or that may well lead to more people being refused at the gateway. But I think every indication from the FCA so far and what they've said publicly is, well, okay, that may be, to use a slightly callous sort of phrase, a price worth paying if the outcome is actually, less fraud, better outcome for consumers, fewer consumer complaints, etc., etc.
A price worth paying. It's the cost of doing business for a regulated firm. It's different to any other sector. This is regulation, and I think the I don't mind blank of exactly what I was going to say. Sorry. So I will pass on to to Max. Max, there was a couple of questions that had come in that you wanted to address.
Yeah, thanks, Alison. Just before I do, can I just kind of add on to that, what Chris was saying about enforcement, which I agree with, from a broader legal risk perspective. Sometimes I've had the question, okay, what's this? Where does the rubber hit the road? Where's this going to all go wrong for us? Is it just if we actually have the FCA come and look at us and ask us questions and then take enforcement action? And I think the answer to that is no, that's not the only category of risk here. There is not a private right of action by customers under these rules. So unlike in certain other areas of financial services regulation, a customer cannot take direct legal action against a firm for breach. But a well-informed customer might well, in a dispute, for example, say, well, hang on a sec, not only have you breached your contract with us and not acted reasonably, but you've actually breached this very specific rule under the Consumer Duty. And if you don't resolve this, I'm going to make a complaint. I'm going to tell the FCA about this. That becomes a real live risk, I think, for firms. Another area, a lot of contracts, maybe not necessarily with customers, but certainly with suppliers and banks and other firms, are going to have clauses in there somewhere that say, we, the regulated firm, agree to comply with all applicable laws. And that includes regulation and guidance sometimes. You could be in breach of contract by breaching some of these. That could create liability to you for other, towards other participants and other stakeholders outside of the customer and the regulator. And then lastly, and this is getting a little bit deep into the realm of litigation and legalese points, but there is this concept of breach of statutory duty, which can create an ability for persons to sue another person outside of contract law and outside of regulation. I haven't really fully thought that through, but there might be some other categories of liability. So the broad point I wanted to make here is agree with everything Chris was saying. I think there's also some other legal liability points to think about beyond the rules themselves. So there were two questions in the chat about safeguarding, both of which I think are really good questions, and I suspect they come off the back of me saying, oh, the FCA said safeguarding banks have to follow the rules, which is exactly what they've said. So one of the questions was, the EMRs and the PSRs, that's the money regulations and the payment services regulations, also identify custodian banks and insurers as service providers related to safeguarding. Why have these types of indirect providers been omitted from being in the distribution chain? And I think the short answer for that is, I don't think they have been omitted. I think, given the guidance about safeguarding banks, that's non-exhaustive. That's not saying only safeguarding banks and not insurers. So again, what an insurer would have to look through the rules very carefully and think about where they're in scope and when they're not. But I suspect in most cases they would be in scope. What that means in practice is very difficult. how do you, as a provider of insurance for safeguarding for a payment institution, make sure you follow the duty? And I think it would be fairly narrow in practice. It would be making sure your insurance properly covers the relevant funds that need to be safeguarded, and that you have a good method of communicating and reconciling that with the payment institution. But it certainly puts some additional onus on you as a safeguarding bank or insurer that maybe wouldn't have been there before, at least not to this extent. There's another question for the same person. Does the safeguarding obligation imply that other B2B banking services, e.g. correspondent banking, are now in scope? And this is not, there is no simple answer to this. It depends is the answer. Certainly I can think of situations where I would think the FCA would say that a correspondent bank providing, that is itself FCA regulated, which is providing services to, let's say, an FCA regulated e-money institution or payment institution, and is part of that payment chain, is part of how the money gets from the payer to the payee, I would think the FCA would say, yeah, that is in scope, and they probably have a reasonable basis for doing that based on the final rules. It does depend on the nature of that relationship, and it does depend on whether the underlying customer of, in my example, the payment institution is a consumer, micro enterprise, or small charity. But short answer is yes, I think it could apply there.
Thank you, Max. I have remembered what I was going to say, and it ties in with what Max, you were saying, and Chris. It was 2 points. First of all, in the context of Project Regulator, what we've heard very clearly from the FCA is that if there is something that comes to their attention about a payment or e-money institution, they will look under the cover, the whole blanket off. So, one question could lead to lots of other questions on this. And I think that's an important point for firms in understanding how you want to avoid coming to the attention of the FCA perhaps, or have your house very definitely in order. And the other point was in terms of the price worth being paid. There is a very strong question coming out of the FCA as to how the number and level, the volume of applications in payments and e-money continues to remain high, and the viability of so many applicants and so many new businesses in the market. Now, it's a dangerous place for the regulator to go to in terms of how do they choose which horse to back in terms of the economics of it and the viability. But nonetheless, it's a question that's being very definitely posed to applicants with a view to, is this the numbers in this sector really going to stack up in future?
And I would say, to add to that, that reinforces the point about the wind down plan, the quality of wind down planning that's expected, not just from firms seeking authorization, but from those already who are authorized.
Exactly. And we can see it all tying through.
Is it worth touching on what we're expecting from the FCA? I think they have said that they would be conducting outreach for different sectors about this time, actually. So I suppose one of the key things is that we will all be waiting with bated breath to see any specific things that come out further for payments that will help guide us in our implementation.
That's right. And I think we're expecting perhaps some kind of direct communication. I know there's ones being set up for various trade associations, and that might follow through for various sectors, and perhaps even a letter, a Dear CEO letters. It was that one of the tools that they might be using.
Yeah, I think that's what we heard. Yes.
Can I check if anybody would like to make any concluding comments? Anything else, Melissa? Thank you for that. Is there anything else that anybody wanted to mention and hadn't got the chance to bring it to our attention?
I suppose there's one sort of point that I think we can leave with, and it might give some comfort to particularly smaller firms, is that while it's absolutely important, this is, given the emphasis and the time and energy it deserves, we can be reasonable, we can be proportionate, we need to get cracking, but we can also look for the opportunity in this, because being customer centric is a good thing. And if it enables us to take a more coherent and holistic view end to end across all the different business functions that can in some way impact on that customer outcome, then actually we should end up with better quality businesses. And you know, I think there are some opportunities there, and I think that's important, particularly if we're coming from a risk and compliance place and trying to engage and drive action throughout our businesses. You know, this is not something that can be done by compliance in isolation. It's going to be very much a collaborative effort, and we need to leverage those sort of drivers that appeal to each of those functions. So whether it's thinking about you know, the customer relationship management, you know, building on what's already being done and actually just trying to take it to the next level. So there's still very much a role for compliance and making sure that whatever gets done, we can trace it back to the rules, and we've got our evidence and we know our monitoring and so on, and pulling that side of things. But is that actually something that can be properly built into the fabric of our firm and actually be the outcome that deliver the outcome that the FCA is looking, which I think is a good thing.
Melissa, I think that's a beautiful conclusion there. What's good for consumers will be good for business. We've had a great discussion, wide-ranging, over the various implications in terms of the fundamental shift. We can all see that there is a job of work to be done. It'll look different for different firms in different places, and there are various aspects of where they are in the manufacture, the distribution chain. We can see that there will be time and effort being made to understand that, document that, evidence it. There'll be plenty of focus groups and mystery shopping, I think, but we're looking to the conclusion, which is you know, this isn't just a job to be done. It's a change that will be very welcome in particular areas. Might not be a huge fundamental shifts in every business, but gradually over time, I think we can see that it will be moving to a broadly better place. With that, I will thank you all for participating in the panel. You've been brilliant contributors. Thank you so very much. Thank you to the Payments Association for hosting us. And thank you to all the participants for your brilliant questions. And we all, no doubt, will be happy to speak to you individually or separately or whatever after. You can certainly get in touch with us either through the Payments Association or directly. Angela.
Thank you, Alison. Yes, just to echo what Alison said, thank you to all of our speakers. Brilliant session. I think lots of food for thought. I think everyone's going to be going back to their desk with a few considerations there. So really insightful, really inspiring session. And also thank you to everyone who attended today's webinar. If you do have any other questions, please do contact Emily Beard. Her email address is emily.beard@thepaymentsassociation.org. You will shortly receive a survey on the webinar, and we would appreciate it if you could complete this and provide your feedback, and that would allow us to tailor the next session even more to your needs. You will also receive a follow-up email within 24 to 48 hours with a link to view today's recording, and then you can share that if you wish. And finally, on behalf of the Payments Association and our speakers, thank you for joining us today, and have a great rest of your day. Bye-bye.